Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Jeffrey Christian, who's managing partner of CPM Group. Jeff, always good to have you. Thanks for coming back on the show. Now, I remember the last time we had you on, or maybe the time just before that, gold. We were up near almost 1,900 an ounce, and you said, this is it, time to take some of that position off the table. That was a very prescient call, as we now see gold around $1,600 an ounce. Let me get your outlook on gold and the rest of the precious metals to start off.
Right. Well, starting with gold, I think we did see a cyclical peak on an intraday basis last September. I think that the price will average a little bit higher this year than it did last year, but the price is clearly moving lower. What you're finding is that investors are much more reluctant to buy gold and to chase the price high. Investors are still interested in buying in gold, but they're not going to chase the price anymore. So what you find is when the price comes down to $1,530, investors step up and buy. They've done that 3 times since last September. And then when the price goes up to $1,730 or $1,790 or $1,800, they pull back from the market. And I think that that's likely to continue. So we're looking for the price to come back down toward $1,530 over the next couple months, next few months, and test that, basically trade between, say, $1,480 and $1,730.
What caused this? You called it a reluctance to buy. Was it that this you know, the theory behind gold's rise, at least in recent times, in recent years, the so-called the printing money, the hyperinflation? Is it that there's a realization now that that really didn't pan out? Is that part of this reluctance to buy?
I think there are some people who are disenchanted longs that feel that maybe they have been misled by people who were waving their arms and saying, look, all you need to know is that, you know, the Fed's printing money and that's going to be inflationary. But I think there's another factor, which is that the price simply got so high that it was a compelling time to sell and take some profits or buy puts. And it was a point at which people said, I'm just not going to buy, continue to buying at prices of 1920, 1930, or even higher. So you saw that. But I think there was a sea change in investor attitudes last September, because we had gone through the debt ceiling debacle in Washington. The European leaders were fiddling while Athens burned. And there were a lot of people who were saying, okay, the euro is going to collapse, the treasury is going to be downgraded, all these things are going to happen, and gold's going to go to $2,000 or $3,000. And we had the treasury downgrade, the euro didn't collapse,
right,
and the price of gold came off.
Greece didn't exit the euro.
And I think a lot of people were just looking at it and saying, wait a second, this thing is still continuing. And maybe what I have to fear is not that 2% or 5% probable, fat tail where things really go bad and the euro collapses. Maybe what I really need to worry is the 93% probability that what we have now continues.
Right.
High unemployment, low growth, low interest rates, very few ways to really earn money.
So how does that look? Let's assume it does continue. How does that look? Does that spell sort of a trading range, sort of like the one that we're in right now for the metals?
Yeah, it's going to be very interesting. I mean, we've only talked about gold, but gold is gold, and then the silver is this dual financial asset and industrial. The PGMs, copper, zinc, those are industrial metals, and I think you're going to have play each one individually based on their fundamentals. But yeah, you're going to probably see trading ranges. You probably have seen a near-term or interim peak in commodity prices in general. And commodity prices probably won't move back to those highs until maybe 2015, 2016. So you'll have a couple years of prices moving sideways to slightly lower.
Now, slightly lower on silver, for example, are we talking in the low 20s? Are we looking at 25?
Yeah. Our expectation is that the price will break. I mean, the price has been very stable in the last couple months between, say, 26.50 and 29. And our view is that it probably will move lower. Could go as low as 22, but probably will be, mostly in that $24 to $26 range over the last few months of the year.
Now, where does China fit into the equation, and India? They have historically been big buyers of precious metals. In fact, I think up near the top of gold's recent price range, we saw a lot of buying on the part of the Chinese central bank. We may have even talked about it as a sort of contrarian indicator. Remember when the central banks were heavy sellers in the 90s, and that was the bottom of the range of gold. where does China and India fit into the story now?
Well, what you're seeing is, again, much more price sensitivity on the part of investors. They're not buying when the prices get high. And in India, with a low rupee, you've got record high gold prices. So the Indian gold market has been hit, and the Chinese gold market has been hit too, both for gold and for silver. You're seeing lower imports. You're seeing less investment demand. You're continuing to see jewelry demand and industrial uses for silver and PG and gold and other metals, but you're seeing lower, more price-resistant investment demand, and you're also seeing that on the part of some central banks too.
Let's talk a little bit about the economy, which looked like, at least through most of May, I mean, there was concerns about possibly going back into another recession. And now it looks from some of the data that the economy is starting to pick up. I mean, we still see very good auto sales, even housing, a sector that has been very depressed for the last 5 years. We're starting to see housing starts, I think, are at a 3 or 4 year high. So those are two very important sectors of the economy. Do you see growth picking up? It's pretty slow now. But if so, that would also have an impact on the metals outlook.
If you look at industrial production, if you look at capital equipment purchases by corporations, they're not buying factories because there's plenty of commercial real estate out there, but they're buying equipment for those things. They're posting hiring job listings are at very high levels. So you're actually seeing a lot of strength. Auto sales are very high. It's funny because auto sales came out about 7.8% last month, and people were disappointed that it was only 7.8. That's a very strong growth number.
Sure.
You know, but if you go, you mentioned earlier the whole idea that investors are being sort of disappointed and let down. If you go over the last few years, we've had these slowdowns in the summer months, 2010, 2011, and now in 2012. There's some seasonality there. There's also some broader economic factors. This year, it's kind of been bad in June and into July. Although there are pockets of strength. And each time you saw the pundits saying, oh my God, we're going into a recession,
right,
you better buy gold and silver, this is going to be the end. And after 2 or 3 months of a seasonal slowdown, we picked up in industrial production and in employment growth and other things in the final 4 months of the year. And that's what we expect again this year. And again, you're having investors saying, well, I've heard this song before. I've fallen prey to that siren song before. I've been burned before. I'm not going to get fooled again.
Now, of course, we have the election coming up and also the fiscal cliff. We hear about that practically every day, the fiscal cliff, if the economy falls off the fiscal cliff. And also we're going to have to raise the debt ceiling once again. How do you see these all factoring into the outlook? Are you more cautious as a result of this, or do you think they'll get resolved?
My biggest concern is the fiscal cliff. Dealing with the election, I don't know who's going to win. I only know that we'll lose. Yeah, there's no way that the American people can win in this election. Yeah, it's a disaster whoever wins. With the fiscal cliff is my major concern because politicians will be politicians. These guys are not being government leaders, they're being politicians. They will play with us the way they played with the debt ceiling last August. They will damage America's financial status on a worldwide basis, but then it'll probably get resolved. And it'll probably be some sort of compromise. So that you'll see some negative effects on GDP next year and going forward because of it, but you'll also see some, it won't be as devastating as everybody assumes.
Yeah, and actually the downgrade last year was really a joke because we saw yields on treasuries drop to record lows, approaching zero across much of the yield curve. So I mean, that was really a false kind of fear, don't you think?
Well, yeah. I mean, it's bad to be downgraded, but it was totally a non-event in terms of it all.
Totally.
And what you find, and we're writing about this in our August Precious Metals Advisory, is the probability that what you're going to have is really a credit drain for a long time. You know, people, it's paradoxical, but people are actually giving money to the Fed and to the UK government and to the Bundesbank. You know, these are the guys who really perpetrated deficit spending and have been like the instigators of a lot of our problems, but they have the better credit rating. So you're seeing credit availability at low interest rates increase to these guys, and the rest of the world's being credit starved. So that's going to reduce growth on a global basis. It's going to cause a lot of other economic problems, but it's probably going to continue for the next several years.
All right, so no cliff, but basically a continuation of the present. What we should fear the most, a continuation of the present, right?
Exactly. I think that's our view.
All right, Jeff Christian, thank you very much. Always a pleasure having you.
It's always fun being here.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.